Welcome to AB Cardano. AB Cardano is your guide to professional trading by providing free educational trading material and strategies. Now, let's start a video. Question number 6. What does Elliott Waves degrees or magnitude mean? The answer is many different degrees ranging from grand supercycles spanning 200 years to a sub-minute degree covering only few hours. The basic 8-wave cycle remains constant no matter what degree is being studied. Each wave subdivided into waves of one lesser degree that, in turn, can also be subdivided into waves of even lesser degree. A given wave divides into 5 or 3 waves is determined by the direction of the next larger wave. Question number 7. What is the description of each wave of the 8 wave in a cycle? The answer is Wave 1. Wave 1 is rarely obvious at its inception. When the first wave of a new bull market begins, the fundamental news is almost universally negative. The previous trend is considered still strongly in force. Fundamental analysts continue to revise their earnings estimates lower. The economy probably does not look strong. Sentiment surveys are decidedly bearish, put options on vogue, and implied volatility in the options market is high. Volume might increase a bit as prices rise, but not by enough to alert many technical analysts. Wave 2. Wave 2 corrects Wave 1, but can never extend beyond the starting point of Wave 1. Typically, the news is still bad. As prices retest the prior low, bearish sentiment quickly builds, and the crowd haughtily reminds all that the bear market is still deeply ensconced. Still, some positive signs appear for those who are looking. Volume should be lower during Wave 2 than during Wave 1. Prices usually do not retrace more than 61.8% of the Wave 1 gains, and prices should fall in a 3-wave pattern. Wave 3. Wave 3 is usually the largest and most powerful wave in a trend, although some research suggests that in commodity markets, Wave 5 is the largest. The news is now positive, and fundamental analysts start to raise earnings estimates. Prices rise quickly. Corrections are short-lived and shallow. Anyone looking to get in on a pullback will likely miss the boat. As Wave 3 starts, the news is probably still bearish, and most market players remain negative. But by Wave 3's midpoint, the crowd will often join the new bullish trend. Wave 3 often extends Wave 1 by a ratio of 1.618 to 1. Wave 4. Wave 4 is typically clearly corrective. Prices may meander sideways for an extended period, and Wave 4 typically retraces less than 38.2% of Wave 3. Volume is well below that of Wave 3. This is a good place to buy a pullback if you understand the potential ahead for Wave 5. Still, fourth waves are often frustrating because of their lack of progress in the larger trend. Wave 5. Wave 5 is the final leg in the direction of the dominant trend. The news is almost universally positive, and everyone is bullish. Unfortunately, this is when many average investors finally buy in, right before the top. Volume is often lower in Wave 5 than in Wave 3, and many momentum indicators do not reach a new peak. At the end of a major bull market, bears may be very ridiculed. That was a 5-wave pattern, dominant trend. Let's jump to 3-wave pattern, corrective trend. Wave 1. Corrections are typically harder to identify than impulse moves. In Wave A of a bear market, the fundamental news is usually still positive. Most analysts see the drop as a correction in a still active bull market. Some technical indicators that accompany Wave A include increased volume, rising implied volatility in the options markets, and possibly a turn higher in open interest in related futures markets. Wave B. Prices reverse higher, which many see as a resumption of the now long-gone bull market. Those familiar with classical technical analysis may see the peak as the right shoulder of Head and Shoulders reversal pattern. The volume during wave B should be lower than in wave A. By this point, fundamentals are probably no longer improving, but they most likely have not yet turned negative. Wave C. Prices move impulsively lower in 5 waves. Volume picks up, and by the third leg of wave C, almost everyone realizes that a bear market is firmly entrenched. Wave C is typically at least as large as wave A and often extends to 1.618 times wave A or beyond. After knowing about each wave, there are some rules we need to be aware of. Rule number 1. Wave 2 never retraces more than 100% of wave 1. Rule number 2. Wave 3 cannot be the shortest of the 3 impulsive waves, namely waves 1, 3, and 5. Rule number 3. Wave 4 does not overlap with the price territory of wave 1, except in the rare case of a diagonal triangle formation. Michael Covell said, "Never ever argue with your trading system." The meaning of this quote is, it will never get you anywhere. And let's face it, it's probably not the system's fault. If it's really doing you no good, change it. Thanks for watching, liking, and sharing this video. Subscribe to our channel and press the bell button to get notifications of what's new on our channel, and follow us on social platforms.